Howdy, boys and girls. Welcome to Liberty Call. Today is Tuesday, May 7th, 2024. Hope you are having a fantastical day out there in the interwebs. It's a little bit nicer day here in Colorado. The sun is sort of out. Got a little clouds, still a little chilly. I got long sleeves on today, so is what it is. Hope you're having a good day out there. And looks like the markets took a bit of a respite from their jovialness over the last few trading sessions and finished close to the flat line. So let's go ahead. And if it is your first time, there we go, point towards you. If it is the first time that you are watching Liberty Call, yes, you in the brown shirt, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell because you don't want to miss out on anything smart I say. May not be today, could be tomorrow. I pace myself. All right, let's go ahead and get into today's numbers. Dow Jones finished the day up 0.08%, 31 points, closed at 38,884. The S&P 500 was up 0.11%, closed at 5186. Nasdaq down a 0.1%, closed at 16,332. The VIX was down today 1.93%, closed at 1323. Canada up 0.14, Brazil up 0.58, and Mexico down 0.32. Over in Western Europe, Germany was up 1.45%, the UK up 1.22%, France up 0.99%, the Netherlands up 1% flat, Spain up 1.5%, Italy up 0.75%, Switzerland up 1.64%, and Portugal up 0.95%. Russian exchanges, they were both red today. The MOEX down 0.29%, the RTSI down 0.81%. And it looks like all the Asian markets were open today. The Nikkei was up 1.47%, Australia up 1.44%, New Zealand flat, down 0.01%. In China, the Shanghai was up 0.22%, the Shenzhen Component down 0.09%, China 50 up 0.25%, DJ Shanghai up 0.12%, Hang Seng down 0.53%, and the Taiwan weighted was closed today. All right, so those are our markets for today. Let's jump on over to the market recap. U.S. stocks rise as earnings season continues. Let's see what good news is in there. All right, on Tuesday, U.S. stocks experienced gains as investors processed a wave of corporate earnings reports. Notably, Walt Disney saw a significant decline of 9% after reporting weaker than expected subscriber growth for Disney Plus and warning of a slowdown in its theme parks division. Meanwhile, Kenvue surged 6% following strong first quarter performance with plans to reduce its workforce as part of a cost-cutting initiative after spinning off from J&J, Johnson & Johnson for you other folks. However, Planeteer Technologies faced a sharp decline of over 14% due to its annual revenue forecast falling short of analyst expectations. Despite the setback, some analysts remain optimistic about Palantir's prospects in generating demand for its artificial intelligence platform across commercial and government sectors, highlighting a potential $1 trillion opportunity in AI. Lucid Group also experienced a significant drop of 15% after forecasting higher capital expenditure for the year and maintaining a less than ideal annual production outlook due to sluggish electric vehicle demand. Apple made headlines with the launch of its new iPad Pro and iPad Air models featuring the new M4 chip in a virtual event. This announcement precedes Apple's upcoming developer conference where speculation is ripe about the company unveiling its artificial intelligence strategy, potentially sparking an AI-driven supercycle. Beginning with the new iPad lineup and extending to the iPhone 16 release this fall, according to Wedbush analysts. In another sector, fitness company Peloton Interactive surged over 16% amid rumors of a potential buyout interest from private equity firms, as reported on CNBC. The speculation propelled Peloton stock higher amidst ongoing market volatility driven by corporate earnings and strategic developments across various industries. All right, so that is the news for today. Do you feel, I know I feel smarter just going through that. You know, these folks, these journalists are amazing people. All right, some more, I guess this is positive news. U.S. Social Security Medicare gets slight boost from a strong economy. Let's see what that has to say. The U.S. Treasury's trustees report revealed slight improvements in the trust funds supporting Social Security and Medicare benefits for seniors, thanks to stronger than expected economic growth and productivity, which boosted revenue collections. According to these reports released on Monday, the Medicare Hospital Insurance Trust Fund's reserves are now expected to last until 2036. Woohoo! I think we're going to squeeze an extra few years out of that. 5 years later than previously forecasted. After depletion, the fund will still be able to pay about 89% of scheduled benefits based on annual tax collections. Seriously, folks, do you think the United States is still going to be around in 2036 to be paying Medicare and Social Security benefits? If you do, I got a bridge for you out in Arizona I can sell you. Similarly, the combination of Social Security trust funds are now projected to be depleted in 2035, 1 year later than the last year's estimate, and with the ability to pay 83% of scheduled benefits afterwards. Great. Right about the time I'm getting into my 50s and 60s, there's going to be no money left. Thanks, boomers. I really appreciate it. Despite these extensions, the report underscores the long-term solvency challenges of these critical programs, which I never agreed to. I'm just being robbed to pay for them, which constitute a significant portion of the federal government's expenditures. With the retirement of the baby boom generation, Congress faces the necessity to strengthen these programs through revenue increases, cost reductions, or benefit adjustments. The Biden administration has proposed raising payroll taxes on individuals earning over $400,000 to address these challenges, rejecting benefit cuts. The report highlights the urgency of addressing these issues to avoid automatic cuts to Social Security and Medicare benefits. Personally, I'd just like to be able to opt out of this and get my money back, because just since 2020, since the year 2000, the federal government for federal taxes, Social Security, Medicare has taken about $800,000 from my wife and I. So I would just give me the money back. I'm a professional investor. I could do something with that. The economic growth exceeding expectations has positively impacted tax returns, productivity estimates, and trust fund projections. Notably, the Social Security Old Age and Survivors Trust Fund depletion date has been delayed by approximately 7 months to November of 2033. Additionally, the Social Security Disability Trust Fund is now projected to remain solvent through at least 2098. I don't care, won't be alive then. A significant extension from previous estimates. The Medicare Hospital Insurance Trust Fund has also benefited from cost reductions and policy changes, projecting surpluses through 2029 before deficits deplete the reserves by 2036. These improvements are attributed to increased economic activity and changes in healthcare utilization patterns, highlighting the complex interplay between economic factors and social safety net programs. Again, I never agreed to be part of this. I guess it would have been my grandparents' parents were the ones voting on this stuff back in the 30s and 40s. And, I wasn't even around yet. Hell, my dad wasn't even around yet. So, all right. One last article here. It comes from Zero Hedge, titled Shocking Collapse in Credit Card Debt Growth Just as Card APRs Hit All-Time High. So is this that people are up against their credit limits and they can't borrow anymore? Or, what's the situation? I don't think people are just magically more financially solvent at this point. The latest consumer credit data released by the Federal Reserve revealed a significant slowdown in household borrowing during March of 2024. The total consumer debt increased by only a modest $6.274 billion, far below the consensus estimate of $15 billion, marking a more than 60% miss. This represents a substantial drop from the previous month, with credit growth tumbling by nearly $9 billion. The largest monthly decline in the rate of change observed in 2024. Analyzing the report further, the notable aspects of the collapse in revolving credit growth, primarily driven by credit card debt. Credit card borrowing increased by a mere $152 million in March, down sharply from $10.7 billion increase seen in February, which was the largest monthly rise on record. The sharp slowdown in credit card debt expansion correlates with record high interest rates on cards, reaching an average of 21.59% across commercial banks in Q1 of 2024. This trend underscores banks' reluctance to lower credit card rates despite the Federal Reserve's decision to hold interest rates steady. The decline in consumer credit borrowing comes amidst a backdrop of dwindling personal savings rates in the U.S., which fell from over 5% to 3.2%, the lowest level since 2022, within a short span. This suggests that consumers may be increasingly strapped for cash and equity, potentially limiting their ability to rely on credit card spending. Despite these trends, there are concerns over the sustainability of record high credit card debt levels alongside record low personal savings rates. The upcoming election cycle could influence policies aimed at encouraging spending, potentially leading to continued credit card borrowing, even in the face of rising delinquency and charge-off rates. Overall, the latest consumer credit card data reflects a significant shift in borrowing behavior, with households exhibiting more caution amidst challenging economic conditions and record high interest rates on credit card balances. Again, like I said at the beginning of the article, I would possibly hypothesize that maybe they just run out of available credit. That would lead to a major stop. If all of your cards have $10,000 credit lines and you've maxed them all out, there's not really anywhere to go. I mean, you could call your credit, your bank and say, hey, could I get a $5,000 increase? But then they yank your credit score, or they look at your credit and go, you're maxed out on everything. I don't think that's a good idea. Having been the guy on the other end of that phone, I mean, I didn't do credit increases or anything. I was usually the guy hunting down the deadbeats. But, I've worked in that side of the financial world, and you wouldn't give that person more money. Obviously, they're destitute already. So, alrighty. Well, that is everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you all again next time. Adios.